Is it visible?
Yes, sir.
Okay, fine. Fine. So, as Professor Ranjit has mentioned, I'll be trying to cover up some issues. Biasness. As the title says, bias, I'll focus on bias. And I'll try to see from the perspective of the bias, the behavioral finance. And that will be a micro perspective. Now, this is broadly the title. Let me go to the my presentations. So first is behavior. We all know about our own behavior. We know about the behavior of others. We comment on the behaviors. This is a very common term. A child learns that your behavior, child which cannot even talk properly, they are made to understand that what is a behavior. And they understand this is behavior, that is not good behavior, that is bad behavior. But interestingly, if we look into the more formal kind of definition of a behavior, then people say, the authorities, those who are in behavior, they say that it is the your reaction to the stimuli are raised or aroused in the environment. And then what happens? Stimuli are there, and stimuli are received through sensory organs. God was kind enough. He has given us 5 sensory organs. We receive those stimuli through those sensory organs. Then these stimuli passes are carried by the neurons to our brain. Some people call it hard disk. Those who are more affinity, have more affinity to the computer engineering or computer software, they call it as in hardware. And when they say it is in the hardware, there it is processed. Obviously, there is an input, there is a processing, and there is an output. Now, what is the input? The input is in masses carried by the neurons from the sensory organs. And then what is then? What is the processing part? Processing part is nothing but analysis of these neurons. Some knowledge is already stored in your hard disk, that is in your brain, and these informations are taken to the brain, and these are compared. If it matches, then you are fine, you are happy. Like 2 + 1 is equal to 3, you know it, and then, oh, well, this is known thing. But suddenly you find a picture, a man, who, I do not know what is a man, but a man, an animal whose head is just like a man, hands are just like monkeys, legs are like maybe lions, or for the body is just like a cow, or it has got a tail like an dinosaurs. So we have not experienced. That is, this information is not stored in the brain, and then when the neuron carries these masses to the brain, brains find it difficult, and then we get a little bit troublesome. And we have experienced it many times. We have seen Saurav Ganguly as a captain in the field. When he finds that his plans are not working, he bites the nails. So if that is the case, that is the kind of things happening. So what we see is that the Saurav Ganguly is biting the nail. Somebody is shouting at, or somebody is running, somebody is clapping, somebody is dancing. We have seen Saurav Ganguly to take off the shot, and in the balcony of Lord's, he waved it as a retaliation to the behavior of the Pintoff, what he did in Mumbai. So this is what that is processed, and then ultimately there is an output. So when we talk about the behavior, mostly we concentrate on the output part. But this is output. Behavior and output part is the tips of the iceberg, and behind it there is a processing, there is an input, so many issues are there. Now question is, why we are so much interested in behavior suddenly in the domain of finance? Question is, to answer this, we'll have to understand a very interesting issue. Now, what is that issue? We have to understand that, that there is a concept, behavior in data versus behavior of the individual. Now, those who are in the finance, those who are in the hardcore finance, those who are not in the behavioral finance, those who dislike behavioral finance, those who haven't heard behavioral finance, they talk about finance is finance, it is all about data. What is their behavior? Yes, there exists. We may be unconscious about it, but unconsciously or consciously, when we are studying hardcore finance without behavioral finance, there is also behavior. So what is that behavior? That is the behavior in the data relating to finance. If I give more example, that movement in the data of the sales over a period of 10 years, or movement in the data of the profit or loss of a company over a period of time. Now, if we try to find the relative relationship between sales and profit, then also we are trying to see the behavior in the data. So that was always there. So those who don't like behavioral finance, they keep on saying, okay, well, what is the new thing in it in the behavioral finance? Behavior was always studied in the finance. Yes, it was studied. I do not disagree. But that behavior was behavior in the data, not any other behavior. Behavior in the data in the movement in the stock prices, share price indices, or gold price, or for that price indices. Name anything. So that was there always. The question is, what is the other part? Behavior of the individual. Now here we are introducing behavior of the individuals to make this, to understand behavior in the data better. So when we studied behavior in the data without taking cognizance of the behavior of the individual, that is one kind of finding. And why we studied in that way? We studied earlier behavior in the data without the integration of behavior of the individuals, because it was believed all men are rational. We believe, we still believe we are rational animal, and hence we are different from the rest of the animal. But interestingly, all men are not rational always in 100%, or 100% people are not rational 100% times. That is there. We know it. So when that is the case, the very basic foundation of finance, which studies behavior in the data, which owes its origin to the accounting again, which is, or commerce, which owes its origin into the economics. So it studied that there is a rationality concept, but in real life we know that men are not rational. Now this was one of the assumptions in the science of economics, which assumption was again carried into the domain of accounting. This assumption was again carried into the domain of finance. But we are trying to see here, if this assumption is twisted, if this assumption is shattered, means if we consider that these the rational behavior, human being is not rational, and they are not likely to be rational always. Sometimes they act not as a rational. I am not saying irrational. I am not introducing something else. I am saying acting not as rational. We'll have to be very careful in using these words. Then what is happening? We are trying to look into this behavior of behavior in the data of finance from the perspective of the behavior of the individuals. Now, why we are looking into the behavior of the individuals? Because behavior matters. We know that people, because of the different backgrounds, genetic background, social background, cultural background, anthropological background, political background, so on and so forth, and technological background, and so on and so forth, their behaviors are different. And given the same situation, the people behave differently. I give another example. Working capital management, very, very simple thing. Everybody knows. It is all about inventory, all about sundry debtors, all about bank balances, or for that matter, sundry creditors, bills payable, like that. I'm taking a very layman's example. Now, when if 10 different managers are given in charge simultaneously of an organization, of course individually, do you think all these 10 managers will react to the data in the same way? No. Why they don't react? Because because their behaviors are different. And that is why we find in working capital management, aggressive strategy, moderate strategy, like that. So many strategies in working capital management are there. And this is nothing but the approaches to the working capital management, which is mostly managing the behavior of the data in relation to the working capital, triggered by the behavior of the individual. That said apart. This is the prelude. Now, I have been given to understand, and I had the access to also. In last few days, you have been given a lot of interesting. I envy you, because you have been exposed to by the organizer of the program very, very interesting issues like sensitive analysis, social network analysis, like that, neural network analysis, machine learning, and so on. Fantastic. I envy. And I thank the inventors of these programs, these softwares. Now, why? Because that has made us comfortable regarding the study of macro dimension of the behavioral finance. And if you look into the studies, the classes that you have attended so far, you looked into the behavioral finance, you came to the micro, that there was a macro approaches from macro to the micro. Now, what is that? You over a longer period of time, you collected the data. Now, inside information, how the inside information affected the share prices. So, how a societal network, which societal issues help this behavior, particular kind of behavior, and how it can be applied in behavioral finance. But what we would like to focus, or I would like to draw your attention to the fact that there is a reverse procedure too, looking into this macro approach from the micro approach. Or sometimes I feel like it should be nano to the macro, not even micro. It is nano. Why is this nano? I'll come to, and it's because somebody has already talked about neural finance. So I should say it is nano to the macro. So this part apart. Now, what we find here, that when you have studied so far so many things, it was a mostly collective behavior, macro approach. And when that is the collective approach, then the individual behavior here, it is the micro to the macro. So we will try to understand in these discussions, in this discourse, that how we can look into the behavioral finance from the micro units. Now, before that, then when you look into this domain of the public finance, the earlier versions, the sentiment analysis, this and that, mostly relates to the or focusing or targeting to the understanding of the public finance. But behavioral finance can be applied, rules and regulations, theories, postulates, whatever you call it, this can be applied to personal finance. Now, where is the difference between the public finance and personal finance? I think we all know. But to be very precise, since our discussions will be more on to the personal finance, to be very precise, it is managing of one's own finance. That is the personal finance. Of course, this personal finance includes a lot of things: taxation, insurance, banking, investment in share markets, which includes indirectly or directly stock market, money market, capital markets, and real estate, golds, and so on and so forth. Now, with that preliminary level, let us go to the next level. So the next level is what? It is the bias. So what is bias? We all know what is bias. Do we know that what is bias? Do we know?
Yes, sir.
Yes, what it is?
It basically means.
Yes, sir. It's a perceived mind.
Okay.
Preconceived mind.
It is what sort of mind?
One preconceived transaction of thinking and all.
Okay, fine.
Regarding one fact.
Okay, fine. Any other view? I'm not saying it is wrong. Neither I am saying it is right. I'm trying to elicit. Actually understand with the bias, the meaning of the word bias.
So it basically means
prejudice.
The gap.
Not resist.
What you want to do.
Yes. Gap between.
To do.
Sir,
Yes.
it's prejudice, sir. Bias.
Okay, prejudice. Okay, fine. Now, instead of looking into the hardcore meaning, when we'll say that certain issue or certain activity is a bias, how do we define? How do we define that? Yes, this is a bias.
Behavior.
Yes.
Based on human behavior.
No. His biased behavior. Yes, in the context of how do we say when we can say that this is a biased behavior?
So when we deviate from rational paths, we can say when you deviate from
the distance past.
Yes.
Okay.
It behaves in a particular way.
Okay. Now suppose there are 5 people, just for our understanding purpose. 5 people are behaving 5 different ways when they are in isolated manner. But when they are in a group and they face the same situation, and they are behaving in a 6th manner. Now, which one is the bias and which one is not the bias? I repeat, there are 5 persons. They face a flood situation, suppose. Right at this moment in my neighborhood area, it's a flood. So I'm giving an example of a flood. So 5 people are approaching the flood situation in 5 different ways when they are individually facing. And when they are collectively facing the flood, and they are behaving in another way. Now, which one is the actually biased one?
So the 5 people.
Sir, when 5 people are in a group, then there is a bias.
5 people are behaving in a group, then this is a bias.
So actually, when 5 people they are behaving in another way, they are not reacting to flood.
Reaction to the flood when in a group, it is they are behaving differently. Now, when then which one is the bias?
No, sir. Individual view towards one fact is the bias.
Individual view is okay. I get it. Now, can we look into the
because collective, the psychology itself changes, sir. No?
Yes.
In a collective manner, it changes.
Yes, it is true. Now, yes. And that is why you have provided an interesting issue, that why so far you have looked into the subject of behavioral finance from the macro, that is collective psychology. Now you are looking into the individual psychology, because individual psychology, when the interweaves with the another, what will be the other one, collective psychology? That is very interesting issue. Anyway, so if we
but sir, herding will be a collective psychology, no?
Which one?
Herding.
Yes, it is. Yes. Yeah, you cannot alone. You cannot have herd. Can you have herd alone? No,
No, sir.
It's more than one. Obviously more than one.
Okay.
Anyway, so this, the characteristics or the features of all those answers that you have provided, I thank you, but that gives me an light and enlightens me to understand the word bias, means feature. When we say bias, means there is an element of deviation. That is the first thing. Second, when there is an element, it leads to the second step or corollary. If there is a deviation, that means there must have been some standard. And some standard to the deviation that we call bias or deviation. Now, when these two things are there, standards are there and deviations are there, that results into bias. Whether it is good or bad, we are not saying about that. Now, interesting question arises. Who sets the standards? How do we set the standard? It may be the society, it may be the political system, it may be the economic systems, research findings like that. So many disciplines collectively, even anthropology, even human psychology, your genetics, that everything contributes to this standard. And ultimately, that standards are all what? Standards are fixed based on a certain assumptions. For that reason, every discipline, if you look into, like economics, it is based on 3 pillars. Wants are unlimited. If one want is satisfied, another crops up. Like that, every subject has some assumptions. And for that matter, in every research, assumptions are required. Now, is the word bias is just opposite of rational? Or irrational is same as bias? What is your view?
No, the individual who thinks, he must be thinking, he's thinking rationally. It might be irrational from others' point of view.
Okay. So, if there are multiple rationality for the same issue, then we find what? Can rationality be multiple? Okay.
No.
Let's look into this issue from the different perspective. Our brain has got what? 3 domains. Bloom's learning taxonomy tells us that we learn and because of 3 domains present there. One is cognitive domain, another is affective domain, and another is psychomotor domain. And when reasoning, your psychomotor domain, that is the outward manifestations of your movements of bodies, limbs, whatever it is directly controlled by your cognitive domain, we call it rational. And when this is influenced or bulldozed by your affective domain, means all the adjectives, means your emotions, hatredness, anger, love, whatever it is, when that is little bit is tempered, that is your affective domain, then your psychomotor domain is different. So we call this one as the bias. So I repeat, manifestation of the activities of the psychomotor domain purely and purely dominated and influenced by your cognitive domain with 0-degree influence of your affective domain is considered to be the rational one. And if that is not there, irrational, mad person. Is mad person a bias or mad person is an irrational person? That is a very interesting thing. We say it's irrational behavior. Oh, irrational behavior, there's mad person. We will have to understand that. But bias is not irrationality. Bias is not an irrationality. It is what? Little bit of impact of twisting of or influence of affective domain over the cognitive domain, thereby changing the psychomotor domain. So we'll try to understand in that way. Now, how many types of biases are there? Any idea?
Two types,
Yes?
I can say, cognitive and
Two types.
heuristic biases.
Yes.
So cognitive and heuristic bias.
Okay, fine. Any other? Can any other
So
one?
emotional biases also exist.
Okay. Can there be biasness in the psychomotor domain? Or it is always the biasness in cognitive domain, biasness in affective domain? Psychomotor domain means your movement in the your limbs. Now let us there is a famous scientist Stephen Hawking. Was he not a different kind of person, differently abled person, sitting on the wheelchair?
Yes.
Yes, sir.
Yes, sir.
So, do you expect him to do what normally we feel that a person will do because of the influence of the psychomotor domain? No. So there may be, yes, there may be. Absolutely right. Now, this biasness that we have just now pondered over is based on the life science. Now let us look into the biasness from the perspective of the psychology. And interestingly, management of finance, I mentioned earlier, the company is saying, and if 10 different finance managers are given in charge, they will, it is not that they do not know finance. Suppose they are all toppers from Harvard or top ranking management institutes. They have the best of the level of knowledge, and there is no difference in the marks. Suppose, just hypothetically, marks are same everywhere, all are gold medalists. Do you think all will behave in same way? No. Why do they don't behave? It is because of the psychological issues involved. Now, from that psychological perspective, when we look into the finance, then we would say that yes, we are landing into the domain of behavioral finance. So what we will try to see, types of biases, or we would like to say population of biases. I think during the last few days, you have studied about Harding. Somebody was talking about Harding bias. Then any other bias that you have heard so far? Am I audible?
Yes, sir, you are audible, sir.
Yes. So, what are the other kinds of biasness you have heard about during these days, from 30 till date?
Sir, they have explained about different kind of biases like hot hand fallacy, gambler fallacy, or you can say disposition effect.
Okay.
Disposition effect, sir.
Okay. So, roughly, how many biasness you have heard about?
The self-control bias.
Huh? Yes. Okay. No, roughly, how many you have? I don't want the exact one, but how many you have heard about? 10?
Yes, maximum 10, sir.
Maximum 10. Okay, fine. Now we will try to see the types of the bias or the population of the bias and what do they portray. So let us see. I'll have to change over it. I will go to some others. Is it visible now?
Yes, sir, it's visible.
Is it visible? Okay. So here is a list, population of bias.
Sir,
Yes.
can you just zoom it a bit?
I have to zoom it. Okay.
Yes, sir.
Okay, just a minute. What I'll do something else. Okay, there is some problem. Anyway, I'll be helping you out. I'll just send these materials to you. But yes, let me name some of the biases. Action bias, adverse selection bias, affect heuristic, age-related positivity effect, risk asymmetric dangers, ambiguity bias, anchoring bias, arbitrary coherence, limits of attention, the cherry coke effect, bystander effect, choice deferral, choice overload, cleverance effect, cocktail party effect. Then you have attribution bias, appeal to authority bias, Babe Ruth effect, backfire effect, Berman effect, then cognitive depletion, cognitive dissonance, and commitment bias, confirmation bias, conjunction fallacy. Now you may be thinking some questions, sir. How many you will name? Believe me, during my research regarding the behavioral finance, I could still identify 140, almost 40 plus 41 type of biasness, and these are really impacting our financial decision. Is it not surprising? Is it surprising?
Yes, sir. Yes, sir.
Yes, sir. Surprising, sir. 141 is really surprising.
143, I should not say 43, I should say actually 141. 141 types of biasness I could so far identify.
Once we have discussed 147, yes. 48, sir.
The 48, there are 48, yes, yeah. 48.
148.
Look, this is very interesting. This is very, very interesting. And interestingly, as an investor, dear participants, do you invest? Do you invest your money?
No, sir.
Yes, sir.
Yes, right. All of you invest, or you don't invest? You whatever salary or whatever your income, you just spend it. Obviously, you don't spend. You save it, and you don't save it. You save it to multiply. When you want that your savings should multiply, you are thinking of investment. And once you are thinking of investment, knowingly or unknowingly, you pass through this type of biasness. Which have you ever thought of this? Now, what is what? I will come to the details this a little bit later. But what is the case here? Here is interesting situations are there. A research was done with young investors, mostly within the age group of 40, and a few respondents were beyond the age group and above 40, and they were asked to comment on whether they get influenced by this type of behavior. Now let me take one or few examples. So limits of attention, this is a biasness. What is this biasness? I have the inability to attend to multiple things at one point of time, and with this limitation I invest. Do you? Do you?
Sir?
Yes.
I would like to ask a question here.
Yes, please.
If a person decides not to invest, isn't that also a bias? Won't that also be an investment bias?
Yes. Having no answer is also an answer. Okay. I don't know, that is also an answer.
Okay, so in that case, which of the categories that you have listed out, which category of bias this could fall into if I chose not to invest, or I have my salary and it is there?
Yes. So you are rightly raised the issue. What you are talking about, it is the output part. But what is the input part? What is the processing part? Output may remain same. Output may remain same. Now what? 2 plus 1 is equal to 3. Output is same. Somebody is doing it orally. 2 plus 1 is equal to 3. Somebody is doing it but using the fingers. Somebody is getting 2 plus 1 is equal to 3 using calculators, but processes are different. Results are they are getting the same. Am I getting you? So someone is not investing, that is fine. But why? Which process? What is the process impacted them? That is more important for us in behavioral finance. Now it may be what? I am not investing because I have the inability to attend multiple things at one point of time, and what with this limitation I don't invest. I am so confused where I have to invest, so I don't invest. Share market, do you invest in shares, or all the participants invest in shares? I believe not. Is it that they do not know about the shares? I believe not. They know every one of it. But why they don't invest? One of the reasons may be that for investment in the shares, we require attention to various aspects of the information related to the share investment at one point of time, and it requires processing, which the softwares or computers can do, human brain may not be able to do. And hence I decide, oh, this is a very complex thing, and I withdraw. This may be one of the reasons. Or else what? Oh, so many people are not investing. I look around for what? For examples. We want to live by examples, following others. This is a hard behavior. Hard behavior. Or we wait. I will not take any decision. Right now I am not taking any decision. Let me wait. Now this happened when Maruti car came to in India. Many people didn't buy the car. It is not that they didn't have the power, money power. They had. Why they didn't buy? Koi na koi to murga to bane. Means let someone buy, face the music, and based on this experience and outcome of the use of that Maruti car, I will buy. And that happened. So in not investing, not buying the car, this is also that reason. Now, not investing right at this moment doesn't mean that I will not invest for the whole life. It may happen, it may not happen, because it keeps on changing. It is a dynamic issue. Am I getting you, madam? Am I audible? Am I audible?
Sir, you are audible. Audible, sir.
Okay. So what we do now, what we'll try to see is that this is a pool. So we have seen types of bias or population of bias, and what do portray? They portray different types of behavior. Now what we'll do, we'll try to see descriptive statistics analysis practical. So what is that? We have actually seen this. We have actually seen this. What is this? Here. Now, suppose, can you see this limits of attention? Here is one figure, 2.9901. What is that? This is the mean value. What is this? This mean value stands for? In a 5-point scale, a group of investors were asked this question. What is that question? I have the inability to attend to multiple things at one point of time, and with this limitation, I invest. So they were asked, do you agree this statement? Or whether you strongly agree, somewhat agree, you neither agree nor disagree, you disagree, you strongly disagree. So there are 5-point scale. And there are a large number of participants. They numbered it, they gave their opinion, and what we found, based on these values assigned, it was 2.9, means close to the 3, means more or less they think that yes, the entire people do not believe that strongly, but some believe strongly, some believe that is not that influential, like that. And this 1.15374, this is the standard deviation value, means how far they are cohesive. Is it everyone has given 2.9, or how many of them has given 5, or how many has been given 1, whether there is a dispersal, large number of people has given this is given by this, and other figures are like what, skewness and kurtosis. So that means we can calculate descriptive statistics for each of the biases. So how can we calculate? We can have a questionnaire, and based on the questionnaire, we can elicit the information from the investors on each of these biases. Now, interestingly, instead of writing your view of limits of attention, you will have to write this statement, because all investors are not aware of the terminology limits of attention. Am I clear? Or another, let us take it, ambiguity aversion. This is again another kind of bias. So instead of writing ambiguity, your opinion about the ambiguity aversion, what will say? I don't mind risk, but I hate uncertainty involved in the risk of investment. So this is very interesting. Ambiguity aversion. Now what is this? I don't mind risk. I want to take risk, but I hate uncertainty. Risk is always uncertain. If certainty is risk is certain, that 0 or 1, then if it is 1, then you will invest. If the risk is 0, you will invest, and risk is 1, means highest, you will not. But in real life, this is not there. In some cases, sun always rises in the east, eternal truth. So in those cases, you don't have risk. But financial domain is not governed by the 0 and 1. It is always in between, and nobody knows. So this is a dichotomy, peculiar situation, so ambiguity. And now, similarly, they were asked, and it is found 3.3. Means earlier, in case of limits of attention, 2.9, but they find that this is 3.3 means ambiguity aversion. They are more biased in respect of the ambiguity aversion as compared to the limits of attention. So I am not going to the unnecessarily other details, but if you so desire, I can. So this is the descriptive statistics minimum that we require to take care of. Now, once we have taken care of the descriptive statistics, now what we'll do, we'll try to use neural network practicals to see the impact of individual items on portfolio of selection selection. So what we'll do, we'll try to do some practicals. Now what is that practical? Already data is loaded. Now if you look into, is it visible? Is the screen visible?
Yes, sir.
So let us go to the data variable. I have not gone into too much of complexities, but I'll try to help you out. So what I will give you the impression that what is this variable 1? This variable 1 to how many variables you can see here is that 140. We have considered 140 variables, means 140 different biases from that list. And here variable 141 will give us the sum of the values of different biases, means this 140 biases. And 143, variable 143 is categories of investment profile. Now what is this categories of investment profile? Let us look into it. Now here, can you see it? Is it visible?
Yes, sir.
So we have asked, in the research process, it was asked to the participant, what are the kinds of investments you have made? Now, first one is basic. What does basic investment stands for? Investment in bank other than the savings. So it was assumed, again, you see, it was assumed that everybody has got the bank account. It is obvious. Next kind of investment category is mixed, where it is what? They have the bank, then other than the savings, and they invest in capital market. When you say capital market, it includes share, bonds, and everything. Even mutual fund has been considered in that way. Now, another category was thought of, it was miscellaneous, third category. What does it mean? It includes insurance, gold, investment in silver. These are rare. And another category of investments, those respondents mentioned, the basic category means the investment in banks other than the savings account, capital market, and real estate. This is very interesting. Another group of found, they had the, in addition to the savings, they invested in banks, other schemes of the banks, and they had invested in the real estate. And another category was that they invested in real estate only. So during the process, the 6 different categories of portfolios of investments were observed. It keeps on changing. It keeps on changing, but during that research, this was observed. And what is the case here is that, sorry. This categories of investment profile. These all 6 categories were recorded. Now, what we'll try to do is that we'll try to see how the first variable. Now, here variable is nothing but one kind of bias. So, what is the first bias? We have seen it. The first bias is what? Can anyone name what is the first bias that we have seen?
Action bias.
Action bias. Excellent. So we would like to see the influence of action bias or adverse selection bias or effect heuristics. Now, how individually these biases, this measurement of the biases that has been assigned by the respondents and affected their selection of these portfolios, 6 different types of portfolios. So what we'll do, we do not know what is the relationship between this, whether linear, non-linear, we do not know. And we know when we try to find relationship, there is a lot of issues. Issues means input variables, output variables, how many input variables, how many output variables, whether they are measured in terms of nominal or ordinal or interval or ratio scale, outputs, how the outputs are measured, so many issues. And interestingly, more is the issue, more is the type of the relationship measurement. As against these, we have a very simplest, at the same time, very interesting analytical tool that is called neural network. So we will try to see that multi-layer, what is the, basically it is done, what is the layer involved inside that include these, what is the processing or what the variables and how this is affecting the output. Now, in our study, categories of investment portfolio is the output. It is already there in the dependent variable. Now, what we do, in the factor, we carry this one, action bias. Now, this is the variables. Now, in partitions, you will know 70% and 30%. This is not actually the class of neural network. But I assume you have, or you can learn it, no problem. So here, research will be done of the 70% of the data. These calculations, every relationship calculations will be done based on the 70% of the data, and this finding will be tested on the remaining 30% of the data to see how far it is finding is correct. Now, this is architecture. This is not the training group. Okay, fine, batch training. Output, fine. This is descriptive, diagrams, synaptic weights, and model summary, classification results. But for our purpose, diagram, these are necessary, but to make the things limited, very precise to our discussions, we will more concentrate on the model summary and classifications result. So what we do, we click on OK, and we will find a result. Let us see what is the result popping up. So here what we find that hello. Yes, it is taking time. Just bear with me. Yes, it is coming. Multi-layer perception. Now, what is the layer? In factor 1, factor variable 1 and dependent. Sorry, dependent variable 1 categories of investment profile, and this is what the picture of you can say network diagram. Now here the inputs is variable of that first one 1 2 3 4 5. So 5 categories are there, and this is the output 1 2 3 4 5 6 types of different investment, and how these are impacting this moderating variables or hidden variables, and how they are affecting the others. Okay, fine. That is not the issue. Issue what we will have to look into is the model summary. Now what we find here, percent here, the percent of incorrect prediction. What does it mean? If we believe this, and in this neural network, it is free of any relationship, linear, nonlinear, data free, anything. It is possible, and here, if we fit into that, we find model is incorrectly predicts to the extent of 42.5% in case of training group and testing group, and it is equally, it is doing in incorrect prediction in case of 43.4%. That is the number 1. So we'll have to understand here that only one bias is not helping to identify that based on this bias only we can say yes, or because of the presence of action bias we will be able to identify why people are investing in different categories. Similarly, if we analyze again with the neural network with the same thing, but what we'll do this time we will change the variable factors, we change it and we take it to 2. Let us see what does it happen. Now here also we'll find a very interesting issue. What is that interesting issue? Similarly we are getting it, but model summary if we look into, here is also 41.8% are incorrectly predicting. But in the testing, it was found 44.9%, which in other words, the 100 minus 44%, they are correct. Almost, you can say 65 point something. Means it better is what? Better is always that it incorrect, precision or error is lower than the 20. So individually, we find these biasness are not predicting the portfolio of the investors, and we believe it that all are impacting each other. So many biases are impacting each other, and here is a evidence-based proof that yes, single bias cannot determine the selection of the portfolio. So this is the main thing that I wanted to show, that neural network helps us to understand that impact of individual items on the portfolio selection. So neural network tells us that yes, it helps us to understand its impact, but it doesn't impact to the maximum extent individual. Then question is, what is the next? So what we'll do here is that we will try to find out that normality test. Why we'll do? We will try to do normality test about what? So let us see. Analyze non-parametric and then we are looking into legacy dialogue, then one case sample test, and here already I have taken these so many variables, 137. So let me take again here this side. Let me do this to 140. Now let us take it to this, and then we believe whether they follow normal distribution or not. Now, why this test is necessary? Simply, we cannot assume that whether data in the population follows normal distribution or not. But many a time we say the large size of the population is huge, then it follows. But I have a sample of almost 1,700, but still I want to check it. Let us go for it and let us see what it does. And interestingly, if you look into this last column of the test, it says it do not follow normal distribution, none of the variables, in isolated manner. What does it imply? What does it imply? So for any further statistical analysis, if the data do not follow normal distribution, we'll have to be very cautious using parametric tests. We'll have to be very, very cautious. So what is the alternative? The alternative is non-parametric test. Even in the classes of machine learning, you have been told that this is non-parametric, like logistic regression. This is again one of the interesting issues. Anyway, I will not get into that. Sir has already taken. But what is interesting here is that we find it do not follow normal distribution. So what we'll have to do? We'll have to follow some non-parametric methods. So this is the first issue that I wanted to test. Now, what we do, next course of action here is that the normality, we will see the reliability test of all items. Why we are going into reliability of all items? Can anyone tell why will be looking into reliability test of all the items? Anyone?
Sir, to check the internal consistency, sir.
Fine, excellent. Now, internal consistency regarding what? You are 100% correct. Even more than 100% correct.
Regarding the constructs, sir, regarding different constructs.
No, but what is the underlying variable? What is the underlying variable? Can anyone help him?
Is it investment biases?
Exactly. No, these are indicators of different, these all 140, these are all different indicators of different types of biases. And we are trying to see that whether all these 140 indicators are really indicating the biasness.
Biases, yes.
Am I clear?
Yes, sir.
Like to its analogy is very simple. When there is a paper on mathematics, a question paper, marks given not for say algebra. Marks in mark sheet it is not given for what's the calculus. It is everything total. The marks in mathematics is this, but your test is done on different areas of the syllabus. Means your different areas knowledge level is summed up, and then this is considered to be your level of knowledge in mathematics. Here is the same. We are following the same thing. Am I clear? So we will try to calculate this one reliability test here. Reliability test relating to what? Reliability test relating to the all the this 140 items. আমি ক্লাসে আছি একটু, হ্যাঁ। So let us go for scale reliability analysis, and already fitted. These are fitted. Sorry, I made a mistake. So what I do, right, 140. Take the items. Now there is some variable measured in string. String variables are not allowed. Now what we'll have to do? I have to find the string variable. Anyway, I know it. What is that? But for that reason, let me look into different way. 45. So all items. Now alpha, that is there. So statistics, we are an item scale if deleted. This is not the required correlations. We are not interested in. We will not interested because of some other reasons to this test of additivity. Okay, this can be done anyway. Still, we have to cut short our old discussions and to be very precise. Let us take only the calculations of this value. Now, what do we find? Very interesting. Reliability score is how much? 0.967. What does it mean? What does it mean?
Very high reliability, sir.
High degree of consistency.
Reliability, sir, more than.
Yes. Please continue. Reliability is.
So there is a high degree of consistency.
Yes, high degree of internal consistency. What does it mean? All these 140, 39 items are actually converging into the measure of what? Biasness. That is very interesting issue. So what does it imply? This population of biasness that we have seen, what does this imply if we consider the measure of reliability scale? Can anyone tell what is the implication of this measure?
Sir, in my opinion, it means that all the indicators of the behavioral biases are connected to each other, that they are affecting each other.
Not only affecting, in unison, they are leading to the overall bias.
I mean, sir, they are converging to each other. They are converging at a point.
And they are additive.
Okay, sir. They are
additive. One is helping other. So, in other words, when we want to study anything about behavioral bias, if we study it from not from the macro to the micro approach, but from the micro to the macro approach, what our finding, of course, this research is still preliminary stage. I am sharing my views on this to get a feedback from you. So this preliminary level of study reflects that whole host of almost 140, 139 different kinds of behavioral biases that really exist. That is number one. Second, sum total of individual biasness, this degree of biasness, really contribute to the overall biasness. This is one. Is it true?
Yes.
Do you agree?
Possibly, sir, if there is a high level of internal consistency, we should be able to conclude at a macro level that
yes. Now, since it is a preliminary stage, at this level, at this level of knowledge, we'll have to admit, yes, it is like that only. It is indicating in that direction. But why we are saying that it is indicative? Indicative in the sense we have not included the whole host of population. Have we included? No. This sample of how many? What is the size of the sample? 1,740. This 71 excluded because some informations are not there. So anyway, 1669 cases were actually included. But this is a peanut. This is a peanut till we explore or do more researches. If we don't find any other evidences contrary to this evidence, then we'll have to say that yes, this is the finding that there are 140 different types of biases, individual biases, segment of a population of biases, which ultimately determines the overall bias. And these are the mean which individual biasness is higher in terms of this. And here we find 3.3, 3.6, variable 5 is this is there. It is not that all are impacting in the same measure. Even there are some 2.6, 2.9, and even less than that also. So whatever it is, through ANOVA also we find that yes, there is. Anyway, we don't go into that. So our major finding is that yes, when we did the normality test, we have found that the data do not follow normal distribution. So it is an indication that we may have to utilize what? We may have to utilize non-parametric test and reliability test of all the items. When we did it, then we have found that it is highly reliable. Its internal consistency is high, and its implication is that do the biases act individually or collectively? Another interesting observation. They act collectively. So this is another issue. Next we go to the issues of investment. Now, I think I have some more 1 hour time. Can we have little bit of discussion at this moment?
Yes, sir. Yes, sir. We have all the time.
Up to this, can we have little bit of discussions? Anything, any queries, any clarification?
Basically, sir, this study is basically based on the primary data. So you have
Yes.
said that the normality test is important to check whether there is normality or not. So similar test in using secondary data also reveal that if the data are not normal, then we can go for then
Yes, we
chance of bias.
No. Here you see, when population is too large. Now, if we look into small size or big size of the data, that is not important, because for t-test we require we may do on any type of sample size, but get test we cannot do if the sample size is less than 30. So here we can do get test or t-test, whatever it is, because almost 1,500 plus. But issue is, which in many cases, in all the papers, it is many a time it is assumed that whether data in the population will always follow a normal distribution if the size of the population is very big. The size of the sample is very big from the population. And another view is that even if data in the population are not normal, if you take a sample from that, it is believed that it will follow normal distribution. This is another school of thought. But to be very precise, we'll have to see, and this is the beauty of the KS conglomerate minimum of test, is that it will give us a direction. It is not necessary that somebody has already done, a big stalwart has done something good by following some interesting method, innovative method, but violating the basic conditions, the data related conditions, or what are the assumptions that should be, or what are the conditions that must be fulfilled for applying the parametric test or non-parametric test. If we violate that, our findings at the end of the day may not reflect the real truth what that exists in the nature. We will get the answer, obviously. We will get the answer. There are 3 people in one school, and in another school there are 10 people. And if we are to take an average, how many are there in a school? So 10 plus 3 is 13. 13 divided by 2, so it is 6.5. That's mathematically that is correct. Machine is also correct. You cannot say that this is wrong. But in real life context, if you look into, then we find that it cannot be 6.5. It has to be a whole number. So whatever statistics we do, we'll have to see that it actually owes its footing into the real life scenario. That is very interesting. Just a minute. Yes, please. Any other issue? Anyone? Any other issue? Am I audible? Am I audible?
Yes, sir.
Any other issue, anyone? Okay, Professor Ranjit. Can we take break of 5 minutes? Then we start the next session. Will it be okay?
Yes, sir.
Will it be okay?
Yes, sir. Yes, sir. We can have a break.
Let us have a break for 5 minutes.
Thank you. We'll join by 11:30, sir. Okay, sir. So we will join by 11:30. That's fine.
Let us make it 25. Because by 12 I have to make it complete.
Bhowal sir, good morning. Hello, sir. Hello. Bhowal sir, can you hear me?
Hello. Yes, yes, yes. How are you?
How are you, sir? I'm good, sir. I'm good. How about your health, sir?
Taking medicine and under complete supervision of doctor.
Okay, sir. Nice, sir.
How are?
Certainly, class, sir. So, in between, calling.
Yeah. So, was it okay?
Right now, I'm at Kochi, sir.
Okay.
Yeah, my psychology is going on, sir, at Kochi only. So, I got transferred from Kochi to here.
Oh, I see.
It's clubbed with my service as well as studies. Both are clubbed and going together.
Okay.
Sir, actually, day after tomorrow, I'm going to a paper on this internship conference also. That is the behavior finance aspect of Mahabharata, basically, in the knowledge system. There was a slogan regarding this constraint of this Dhritarashtra, where he is saying that actually what all things which I have learned through yourself as well as Ranjit sir and all allied gurus since last 2 years.
No. Everybody is guru. It is just like the story of the lion and the rat.
Sir, actually, what I was intending to club this behavior aspect of Mahabharata, especially. So, what all characters, as well as the daily characters I was intended to analyze, not the winner. So, what I have observed, Dhritarashtra, he ultimately lost everything. It's all 100 kids and everything. So there he is saying one slogan in Gandhari at the end of the story. Janami dharmam najame pravritti, janami adharmam najame nivritti, kena vilogena siddhena yedo tadami, ऐसा करके कुछ last conclusion. So what it says, janami dharmam, I know what is rationality, but najame pravritti, but I don't do it intentionally. Janami adharmam, I know what is irrational. Najame nivritti, but I am unable to stop myself to do irrational things.
Exactly.
Our last one is last 2 lines, which actually says, okay, what those thing comes in mind, and just following it without thinking anything. So, in which sort of bias we can incorporate this character, Dhritarashtra?
This is very interesting. It is inner. I mean, it is a kind of overconfidence, or it is based on the knowledge.
Can we call it as a mere overconfidence?
No. Not only mere confidence. There is some kind of even underconfidence also. Underconfidence because underconfidence that I do not.
He know what things are rational and irrational.
But
he says that I know that my kids are doing the wrong thing.
Huh.
But I am unable to stop them.
Yes.
This happens within Indian mind. Why I am analyzing this Mahabharata, sir? Because in Mahabharata, there was a slogan from the starting itself. It says, "Yedi haasti sadanya ka yana haastina putra jeti." Taska jeti karke, which says what all things happen in the whole world, you can see in Mahabharata. What all things, whether it is eating.
Yes.
You can see in this 1 lakh slogan.
Yes.
So that is the what is called a claim of this Mahabharata.
Yes.
So I was intending to analyze this Mahabharata perspective, why? Because both Savatki as well as our Daniel Kahneman have done, that was related to their collection of the samples and all. So I was intending to analyze it with respect to Indian perspective.
Yes, possible.
That's why I was thinking to go ahead with Mahabharata.
Possible. Acha. Already 11:30 I'm in the class. I know. Yeah, so
In that case, we will discuss it.
yes, tomorrow some other time. Yes. Okay.
Oh, sure.
Nice to talk.
Regarding this program, sir, I will say.
Sure. I will.
Okay.
Okay, thank you. Hello. Am I audible?
Yes, sir.
Yes, sir.
We are energized enough, and I think you can bear my torture. I am torturing you, unnecessarily making you sit and listen. Please pardon me. So let me go to the next part. Investment. Of course, in the context of the personal finance. Our entire discussion was in the context of the personal finance. Now, why I am saying is in the context of the personal finance. If we look into this, the portfolio selection category, here is a bank other than savings, then bank and capital market, insurance, gold, silver, then the real estates, and so on, and in different permutations and combinations. But most of the studies in behavioral finance, most, in the context of the share market, in the capital market, in the context of the money market. So here, one thing we understand that yes, this behavioral finance can be extended, can be applied in the context of the micro level investors. And there can be again another approach from micro to macro. And when macro to micro and micro to macro, when both the approaches merge into one, we will get the holistic picture. Because if we want to see the holistic picture from the aeroplane to the jungle follow, that is one kind of view, and staying on the land is close to the trunk of the trees and looking at the jungle, that is another view. So if you want to have a holistic view, I believe that most of the perceptions that it is always a macro to micro, that is not correct. Yes, I am saying using the word it correct. And when in macro studies, sentiment analysis or using sentiment analysis or social network analysis, or for that matter machine learning, one important thing that we have understood, if we find one result that yes, this is because of the overreaction or this is because of the underreaction, that is understood. But it is because of the what kind of behavior. What we find that different kind of subsets of these biases affects each individual in different degree, and collectively the overall degree of bias is varied. So this part remains unknown unless we look this biasness from the micro approach. This is another realization from this study as far as me is concerned. Now let us start the second part. Now, investment. When we talk about the investments, again I have said we are looking into from the context of the personal finance, and what we are looking into the types. Investment actually, when we look into the personal finance, we'll have to think of the types or categories of revenues. This is only one issue. This study, this present investigation, preliminary investigations looked into the impact of different biases on the types only. It didn't study about the impact on the volume. It didn't study about the impact on time of entry or span of continuation in the in the investment or time of exit. Because every activity in investment is influenced by this type of bias. So I feel there is tremendous scope of use of behavioral finance in the domain of the personal, from the perspective of the personal finance. Now, the impact of biases on categories of portfolio selection. This we have seen this. Now, interestingly, we'll look into this from a different perspective. Let us do some practicals. Now, so far so good. We have seen. Now, here, let us suppose we want to see. Okay, this is the categories of inversion. Right, fine. Another issue. This can you see? Is it visible? Is it the screen visible?
Yes, sir.
Okay. Now, variable 143. It is categories of investment profile, and 141 is the sum of the values of different biases. Earlier, we have seen that these individual items do not follow normal distribution. Now, with the sum of the values of different items follow normal distribution or not, let us also see that. Now, when we look into that, we'll find a interesting issue. Just let us look at it. Yes, this one. Sorry, I have made a mistake. Sorry. Analyze, non-parametric, legacy. Okay, yes. So what we do here is that now we are finding whether sum total of all these are following normal distribution or not. Now what we find here, it is also very interesting. You can understand that it is level of rejection region. Now from there we would like to see the analyze what we'll have to, whether the behavioral biasness, this total scope in terms of, then we will not, I should say total score in terms of averages, whether it varies with different portfolios of investment. So how do we do this? So let us go into very interesting. Can anyone tell me what is this? Can compare means? Can we have compare means? And we do one way and over. And in that, factor is categories of investment profile and some of the scores. So what we do, we okay, just for just we take a test. Now what is the finding? What is the finding? Here we find when we do one way and over, based on the what, different types of investment categories, 1, 2, 3, 4, 5, 6. These are all what? These are nothing but one means only basic bank. This mixed bank and capital. These are 3 is miscellaneous. This basic means bank, capital market, and real estate. And here it is bank and real estate and only real estate. Now what we find in this analysis, when we do the one-way analysis of variance, so highest value is what? 435, 438, 467. So 6. 467. So biasness, mean biasness is very high in respect of C, the category 6. So what is that? 6th category is, I think, with the real estate. And if we look into the further analysis into this, then the list value is 426. Now where is the 426? 426 is, again, if we look into it is which category? 2 is bank and capital market. And if we look into the 1, basic, only the fixed deposits. Now where does it stand? It is here. It is not list. It is the second. There is also problem of what? Biasness. Now, what is the interpretation of this? Or can anyone help me? 467 mean score of overall biasness. It is in case of real estate. In case of bank, it is 435. And in case of bank and capital market combined, it is 426. It is the list. Now, what is the reason? Can anyone tell?
So does it mean that yes, the 435 out of that 1071, I think, is a sample size so far. So 1007.
This is the mean value of the total.
Yes. So this is the average. Respondents who have responded saying that they are investing in category 1, that is bank other than savings account.
No, they are saying that no, not that. They are biased to the extent of 435 degree while investing in bank for fixed deposits and etc., not in the savings account. Interestingly, well, these investors are telling they are biased to the extent of 426 something degree while they are investing in bank and capital market. And investors are telling their degree of biasness is very high, 467, when they are investing in real estate. Now, is it not a very interesting anomaly? And why is it so? What are the possible reasons? Because bank. Yes, please.
No, I said, sir, the possible reasons, are they the investigator or the researcher's opinion, or the possible reasons need to be investigated further with the help of some standard tool?
Yes, but still then, what could be? What can be hypothesis? Why in real estate this is very high? Oh, no, sorry, I think not real estate, 471, something more. What is that, the fifth one? Fifth category is what? Fifth category, basic, I mean bank and real estate. Bank and real estate.
Bank and real estate.
Yes. Now, why it is highest? Bank and real estate. And only bank, it is the second highest. And mixed bank and capital market, that is the very interesting. Why is it so?
Bank and capital market is the least biased.
Yes, least. Yes. I mean, bank means not savings account, other than savings account.
Other than savings account, yes.
So here is, these are also because of the various biases. What is that? Risk, should I keep it locked? With rate of interest is very less, whether share market would give me the more return. And when it is a case of deposit and real estate, now money is locked for a longer period of time. It is not that liquid. We have not considered that liquidity aspect.
And possibly out of the respondents, the number which is investing in bank plus real estate is very less. So that's why that could also indicate or give a direction towards the biases.
Excellent.
So it is the base effect, I guess.
Yes, it is the effect, to some extent it is the effect of the sample size.
Yes, sir.
Yes, you are correct. So our intention was to see that yes, here it is not only in the share market, it impacts this is an interesting measurement that yes, it impacts well. The perception that we have that it only affects in the capital market or money market, it is not the case. It affects this biases influences while investing in a bank other than the savings, or it may be in insurance, it may be in gold, it may be in silver, or it may be in the real estate also. So this is a very interesting issue that we could find out. But here, what we have used ANOVA. ANOVA, this parametric ANOVA. So what is the assumption? Assumption was that the data follow normal distribution. Somebody, yes, but if data do not follow normal distribution as case sample test tell us, then what should we do? We should, I think, go for non-parametric test, legacy dialogue, and I believe it is what K.
Can we do a simple chi-square test at this point just to understand?
No, it will have to be Kruskal-Wallis test.
Kruskal-Wallis test?
Yes. So Kruskal-Wallis test, on what we have to do, it is a non-parametric test. It is an equivalent of the ANOVA, parametric ANOVA. So what we'll do, just let us try. We'll
and Kruskal-Wallis also says that when the mean is different, then they say that in non-parametric Kruskal-Wallis is a better test to use.
Yes, let us see that categories of this. This is a grouping variable, and we see this. The others are there. Define range. Minimum is 1, maximum is 6. So we continue, and then we do the test. Let us see what happens. And here is also what you see here, test result, and here is also seeing the ANOVA. This is put whether you use parametric or non-parametric, it is giving us the same result. It is giving us the same result. But degree of power of analysis or interpretation is very high in case of parametric. Anyway, so that apart, so what we have seen, impact of biases on categories of portfolio selections. We have seen. Now this we have seen this is in terms of the overall. Now can it be studied in terms of one individual biases? Let us see. It is also possible. How do we do that? Analyze. Then what we do, again we go for the non-parametric statistics, we go to legacy dialogue, then k-independent samples. Instead of this, some of these grouping variables, okay, some of this, then what we do, test variables, this is one, this is this, that Kruskal-Wallis test, and this is about the action bias. Yes, here you see for action bias it is something different individually. What is that? What is they are saying? Can anyone tell what is the result? In case of the total, in total, what is the test result? It is 0, 0, 0. And in case of individual, test statistics was not rejected. What is that? What is that? What is the finding? Summary finding. Can anyone tell? Means individual items react differently than that of the total. This is the sum and substance in a very brief way. Other details are there. We have seen the variation of study of the total score by all items of one-way ANOVA, variation of study of the individual scores of all items by the one-way ANOVA. We have seen. Now here, it is very funny question. Are the biases good in terms of investment objectives versus are they good in terms of profit and loss? First of all, are the biases good? Can anyone tell? What is your view?
So you can say that it is good. In many sense, it can be good because it reflects our human error. What the error you are doing, what we are committing error, what taking any financial decision.
Okay.
So, so that reflect our error, and then you can we can overcome that.
Okay, fine. Okay, fine. I got it. Anyone who supports him or just don't support him? Any view?
Sir, this, what you put in green color here are the biases.
Yes, bias.
And all. I think
No. Let us see it in just simple question. Don't make it complex. When the bias is good or not.
No, because if I decide to put money in real estate, that is according to my risk-bearing ability. So then we will say it is a good bias because I am making a conscious decision.
Okay. Okay.
And I'm aware of the risk return opportunities.
Excellent.
But if,
I'm not saying that you are correct or you are incorrect. I'm trying to elicit opinion.
Yes.
As an investor.
And if there is someone who...
And you have all responded to a certain questionnaire?
Yes, I have.
Yes. Thank you for providing the information. Now I'm trying to elicit your opinion whether biasness is good or bad. Now let us. I'm going to do some other part. Some other part in the here. Let me write something. Hard behavior and just for simple no hard behavior. This is, and then here profit out of investment and suppose here we find loss out of investment. So what we find here, can you foresee? Can you understand what is there I'm trying to do? So this is this quadrant, this one, yellow box. What does it mean? It means you have followed hard behavior and you have earned profit out of your investment. And this one is what? This one is what? This box means this box, which let me color it by this one, green color. What does this box represent? You have followed hard behavior, but at the end of the day, you have to incur loss. Now here, what we find here is that, what is here? This box tells us, you have not followed hard behavior, but at the end of the day, you have earned profit out of your investment. And this one is what? This one is, it is this red one tells you that you have not followed hard behavior, but and you have incurred loss. Now situation A, yellow box. A, what is that? B, this is another green. C, another color. And D is the red one. Now when you put into 2 by 2 contingency table, now will your opinion remain same, or you think your opinion will differ? Anyone? Because we have a feeling that let us wait for the others, what the others are doing, and let us follow. This is a hard behavior, or bystanders. Which one is correct? A is correct, B is correct, C is correct, D is correct. Am I audible?
Sir, it can be anyone.
Huh?
Sir,
No. Do you want loss in your investment?
No.
No. That is for obvious. So you want that you should earn profit. Is it not?
Yes, sir.
Now question is here, whether you follow hard behavior or you don't follow hard behavior, at the end of the day, profit out of your investment matters. So what does it mean? By following hard behavior, you may incur a loss also. Because many people applied for life insurance IPO. Did? And what is the situation now? Hard behavior. Those who applied, they followed hard behavior. But they are in the situation this. So, that biasness, following biasness is good, or hard behavior is good, that behavior is bad. This is a very interesting understanding. My perception is that it depends on your end result. What is the end result? Whether you are earning profit or loss. Whatever behavior you are following, it doesn't matter. What it matters, your aim is to earn profit. Now, whether following hard behavior or by not following hard behavior, you earn profit, that you will have to take a risk. And that will determine this. So, blaming particular bias is not the sole thing. If you always follow hard behavior, there will be always profit, there is no guarantee. Or if you do not follow hard behavior, you will suffer a loss. That is also not an it is an hypothesis only. It is an hypothesis only. Am I getting you? So what we find here is that, are the biases are good? Now, when we trying to measure whether biases are good, now whether there are two issues, that whether investment objectives are fulfilled or are they good in terms of profit and loss. And I have discussed this 2x2 matrix. If we apply that 2x2 matrix, that will help us to understand that whether biases are good or not. And interestingly, biases may result into profit, or no bias may result into profit also. This is the interesting thing. Could I confuse you? Anyone? Anyway, now let us take. Okay, so let us take some of the current work in which I am involved in, particularly with respect to. So these days you have seen so many interesting studies, so many techniques. Well, technique is always there, but what I am trying to draw your attention to the fact that behavioral biases or biasness, which results from psychological dispositions, that can be studied amongst the employees, bank employees, their investment behavior. And interestingly, one of the scholars is studying these employees' biasness, investment biasness. They are bank employees, and whether they are investing in their shares of their bank or in the mutual fund sponsored by their bank. And that was whether they are investing in the one or they are investing into both. And because of what type of biasness this is happening, this is being studied. It is still in the process. Another study, that in the context of the self-help group finance issues, biasness. So financing in self-help group, how biasness is impacting. 7 or 8 biases has been taken by the considered by the concerned scholar, and it is on the process. And another entrepreneurial finance. Entrepreneurial finance means is not the big companies; it is micro enterprises, and how their financing pattern or financing function, like sourcing of fund, then utilization of fund, and other issues relating to the finance, is being impacted by their the psychological dispositions that is being studied. So what I'm trying to draw your attention by referring to these work is that the behavioral finance can also be extended towards the other areas also, like other than the shares. We have seen already. It can be in LIC. It can be in bank deposits. It can be in the real estate context, or it may be in the context of the self-finance. It may be studied in the context of entrepreneurship, finance, and so on and so forth. So that is from everything from my side. Now, any queries if you have, or I would like to have your feedback regarding this research progress. Professor Ranjit, from my side, it's done.
Thank you, sir. Yes, any question? I think
Yes.
somebody is, yeah. Please, ma'am.
Sir, I would like to ask one question.